Okay, now in most cases, how do imbalance work, right? So actually, even how do imbalance come in the market? For example, we know that price, let's take an example, price has been pushing, sorry, let me just move that. We know that price maybe has been pushing either to the upside. Price has been pushing to either the upside. Now we just want to focus on that one, or either price was pushing to the downside. Or price, now imagine that this is a downtrend, so how does imbalance comes in? That we know this is a break of structure, so price broke structure to the lower side, and also to the upper side. So there are only two ways we can use imbalance. First of all, it's when we use an imbalance as a confluence. You get it? A confluence, that means it's like an additional advantage that we have maybe our order block here, and there. So one of the factors to consider our order block to be so strong, it should be maybe what? Maybe that here, before an order block, there was an imbalance. You get it? Maybe there was an imbalance that was not filled. That one, or else here. So that is number one. I think this blue line, that's when maybe we consider that as, like, we consider it as a confluence, that we know price is going to come back as it feels this imbalance, it targets this and it pushes away. So when price starts to retrace, we know that price is going to retrace well much enough, it comes back, it feels this imbalance, then buyers continue buying up. Or else price is just going to retrace up to this level, it feels the imbalance, then boom, it does what? It sells. So that is the simplest way, and that it's actually a very strong way of doing what? Of considering your, just a moment. So this is the number one way, and it's also possible, like it's there. That's where you can understand well the use of imbalance. Now the second way you can use imbalance, it is simply like this. Let's take an example that price has been trending upside, right? And it either broke structure, then maybe it came back, it's maybe near, then boom, it makes maybe a rapid move. You get it? And maybe it starts retracing. You get it? So now I'm just going to use this example. Let's take an example that price has been trending to the upside, broke structure, and also broke structure, break of structure. So what happened next? When price breaks structure, it retests at certain zone. You get it? So but when price broke at this structure, it never retested. All right, it did not retest, it went eventually. So what do we see here, or what do we have here? We already have this zone that was mitigated, like its liquidity. So far here now we have sell side liquidity, that price can't come back here and fail. It will either come, pass through it, or makes a sweep, it goes up, or it just continues down. So now this is where the use of imbalance, again, it can be used as a point of interest. So, and we imagine that above our zone here we had certain imbalance. You get it? So this is our imbalance. You get it? This is our imbalance that price has approached there. Now when you use an imbalance as a point of interest, you definitely have to wait price coming back. Price coming back, it creates a new structure and it retests, then you continue. You get it? So that's also the one way you will use an imbalance. You see that in this area we did based on just a little bit, in this area that we based on an imbalance as our point of interest. We based it as a point of interest, and actually we took a trade. But there are conditions to base on as a point of interest. In most cases, what it should do, it should come either be below it should be actually in the discount level. First of all, it should be below the 50%, because you might have an imbalance that's above there. You get it? And also it should have structure shift. That's another way you can use an imbalance. I hope that's also clear. Okay, so let me see. Let me try. Let's say, let me go to gold. Because gold normally activates those things. So I'm just going to show you just a little bit of it. Now, without, if you're actually even not going even further, any further, now you're just going to see that we're just going to see like this procedure. Just let me just try to do maybe a replay. Okay.
Sorry, trading here in Electronium.
Yeah, I have premium.
Yeah, maker.
I don't even remember, but it's little. You just pay per year.
How much?
I think it's even $40. Let me first check here. Like it helps you when you're back testing some things.
Yeah.
Let me see. They say the essential is 25 per month. The plus is 51 per month. Premium, it's 100 per month. But you just only need replay, because if you don't use indicators that ha, these guys we are going to chop. A good thing Apple gives you a protection thingy. Now you see, you're just going to use maybe a little bit of this example. Let me now add the other indicator. Now let me first put a replay mode. Get it? I'm just going to show you how you can get both things. Now you see here, you see that price was pushing up to the upside. It was trending, not until it came and violated. You see, when it violated that area, that was, let me actually even remove even this indicator. Okay, let me just leave it there, just maybe for the target. You see, when it violated here, this was a break of structure. But we already know that this is liquidity or equal lows or equal highs, sorry, that they have been there. So we eventually know that in the case of anything happens, price will definitely come back and clear them out, of which that's what we're not going, that's something that we don't want fall for. So in most cases in trading, you try as much as better for you not to lose any penny. You get it? Now what comes to our next in line? So our next in line is the liquidity. It's here. However much the area is so strong. You get it? So where is the nearest imbalance? The first of all, the nearest imbalance, it's this one. You always find that there is this first imbalance. You get it? But also there is the second one. So what most people tend to do mistakes, they tend, an imbalance, it's like a space between 3 consecutive candles. You get it? You realize that from the first candle, second, and the third, the imbalance was there. Even here on the fourth one, but it was not much. And they're all valid because they are above. They have talked a lot. They are above the 50%. So, but when you tend to have something like this, you should always go for the how can I call it, the climax or the extreme. You get it? So in most cases, you just have to be patient. For us, the problem is we just want to catch each and every move. I think it be a bit too small. You get it? You see? Remember that thing I told you that if you are to
very tricky.
so you remember one thing that I told you that if you are to use an imbalance as your point of interest, you just have to wait for momentum shift or structure so that you can enter that trade. You get it? You can see now, you see how all those things come in line. That of course this imbalance, it tricked some people. You can see it tricked some people. Yes, it showed a reaction, but it eventually broke below. So for you just have to be more much disciplined and you wait for momentum. I'm sure as for now, understand what's momentum exactly. You see? No. You see now what is our momentum? It's this one. Price came. This would be our first entry. If maybe we are basing on that, you would actually have entered. But in most cases, you tend to come when price has already left us. But I'm going to show you another alternative. You be targeting this low. You get it? You just make a little bit of slight move. Now here, maybe you look into the 3-minute, like you go on the lowest time frame to see if there is maybe of any chance, if maybe there were any chance of leftovers. What I mean by leftovers, maybe there may be like some little bit of imbalance or liquidity that might be the reason why price might first come back before it even goes to any other point. Let's imagine that price will come back at that area. Just have to use just a little bit of, I'm supposed to put it somewhere there. You see, price will always torture you. Now, me, in most cases, when I know something like this, that's why you should always stay on your entry levels. You see, on the 15, it is just weeks, and in most cases, you cannot avoid them. But when price still goes on your side, it hits your TP. So as simple as that, that's how we can use it. Just in most cases, when you enter a certain level, you just avoid to put stop loss exactly at your low, because in most cases the price knows. You just have to shift it somewhere far, so that you won't be taken out easier. I think that is for today. That's something. Hope you learned something from there. So in case ngoina kyotategedde obanga you need any other class of formation, oba osobola okuŋŋamba ne tulaba how best you can do that.
And I think I will practice as well.
Let us see Euro USD. Hey. Are you seeing our trade?
Yeah.
It's moving. So, those are together. Never. Wayingiddewo.